Thank you very much. I'm very happy to be here. I hadn't come to this conference in a few years. I took a 3 years break in public policy in Europe, and so it's been almost 3 years I haven't been back, so I'm very happy to be invited. I wanted to thank the governor, Mark, and thank the whole team for the great organization. I'll try to make my presentation quick, and Joshua has helped me by actually going over some of the themes that I wanted to go over. This is what I want to discuss briefly, financial trilemma, and I'll go over a bit of what Joshua mentioned, and we have a lot of agreements. I'll then move on to economic policy coordination, and in particular, what seems to me in a current failure of the G20 to agree on meaningful policy coordination, but what appears to be a resounding success of another form of coordination, which is the bilateral coordination between the US and China. I'll then go on to discuss why we seem to be in a coordination failure, and maybe what will be a more appropriate coordination framework to achieve success. And I'll make a couple of remarks on the international monetary system in the end that echo some of the discussions we had in the previous panel. The work by Ray that has been widely discussed by Joshua is important, but I agree very much with some of the flaws that he has highlighted. In particular, the fact that Hélène, in her stylized work, considers that the only source of global financial cycle would be the US. And I think that ignores very much the fact that we may be much more in a situation of sum of regional financial cycles that sometimes come together to form a global one, but sometimes offset each other. And that's actually the findings of the IMF in the 2015 spillover report, which I thought was very interesting, which goes into building a global VAR model and looks at actually the interaction between the ECB financial cycle and the Federal Reserve. And what it does with this little table at the bottom right is to actually highlight the fact that there are moments where you have asynchrony between the US and Europe, and not only a synchrony between the policy response, but also a synchrony in the underlying macro, and that changes very radically the effect that you see in emerging markets or in other, what the IMF calls non-systemic advanced economies. So I think that's a very important background to have in mind, and that speaks, and I'll get back to it in a minute, that speaks very highly on the need for coordination. So it's not only that the US needs to lead a certain type of policy with respect to the rest of the world, but also that this policy, in particular with the big regional blocs, and I would limit for now this to the euro area and to the US. But in reality, the more you think about it, and this is something that Joshua pointed to at the end, we have to think more and more, at least, of three major regional areas, one being Asia, where China is increasingly displacing Japan, Europe, and the US. And I think it's only by understanding the interaction between these three areas and the financial cycles that they produce that we have an understanding of how to respond at the global level. That leads me to this chart, which is also taken from the IMF, which I think illustrates quite well the interaction between the dollar and sort of global financial stability. The pink lines highlight the number of crises. And what you see very clearly on this chart is that when you have an uncontrolled rise in the dollar, you tend to have, for a number of reasons, very meaningful consequences for financial stability and the eruptions of crisis. What we are seeing now with the rise of the dollar seems to be therefore indicating the potential for very meaningful financial distress globally, and in particular in the economies that are more vulnerable to a strengthening dollar. And that leads me to one in particular, which is China. China is very vulnerable to a rise in the dollar because it is de facto quasi-pegged to the dollar, and therefore it's appreciating meaningfully, and it's tightening its monetary conditions at a moment where it's actually experiencing a very large credit bubble. You could very well imagine, and I think this was what financial markets were very concerned with over the last few months, that a brutal rise in the dollar could prick the credit bubble in China and lead to very massive global consequences. So that backdrop creates a very strong incentive for both the US and China to discuss and to at least come to some kind of coordinated outcome. There's a lot of discussion as to whether this is realistic. Everybody agrees that, or argues that the Federal Reserve has only a domestic mandate and that therefore it cannot engage in these sorts of cooperation. But it's a bit the same thing with a narrow mandate for inflation. If you look at how the external feedback affects the domestic U.S. situation, it's very reasonable for the Federal Reserve to take into account very seriously what would happen in China if it was to adopt this or that policy. And in my view, this is really what has happened over the last year. I think last year when China started to move, the U.S. thought for a while that it could actually increase its policy rate and tighten policy irrespective of what was happening in China. And I think it quickly realized by the turn of last year that this was probably not possible and that a rise in the dollar would have very disruptive consequences in China and by feedback, very disruptive consequences in the U.S. So there seems to have been, some people refer to a Shanghai agreement. I don't think this is anything of that nature, but I think there is an implicit understanding that it's not in the interest of China to let the dollar rise, and it's not in the interest of the U.S. either to adopt a monetary policy that would favor an appreciating dollar. So there seems to be some degree of policy coordination, if be it implicit, but somehow this hasn't happened at the global level, and that this has important consequences because it means that there are some bystanders and some collateral victims of that G2 agreement. The two that come to my mind are Europe and Japan, but there might be others, because indeed, if it's in the U.S. and China's interest to weaken the dollar, there must be other currencies that appreciate in return, and this seems to have been the yen and the euro, even though less clearly so. I'd like to put this very descriptive discussion into a framework, and I refer here to a paper by Frankel which was presented at the San Francisco Fed last year, which I thought was very useful in discussing how we go about international economic policy coordination. Frankel argues that the reason why we fail most of the time to coordinate is because we actually are not trying to coordinate over the same things. And he basically argues that most of the time we are not looking at the situation. We don't have the same model in mind, and therefore we can't possibly coordinate in the same way. He argues, for instance, that on fiscal policy coordination, you have at least two competing models. You have the locomotive model, the locomotive game, which is basically the argument that we need fiscal expansion to support demand. But you have an opposite game, which we could call, which he calls the moral hazard game, but which in fact is the German game, which is the idea that actually fiscal expansion is a source of moral hazard, is potentially destabilizing, and therefore the optimal cooperative outcome in fiscal policy in that case is a tight fiscal outcome. We have the same debate in monetary affairs, where you have two opposite games being played potentially. One is the currency war game, where every central bank has an interest to loosen policy to weaken its exchange rate. But you have an opposite game, which is also, let's call it the German game, which is the competitive disinflation game, where everybody has an interest to tighten monetary policy, strengthen its currency, and secure disinflation in that way. What seems to affect the G20 at the moment is that it doesn't know which game it is playing. Germany thinks that it's in the moral hazard game. The US thinks that it's in the locomotive game, and most emerging economies think that they are the victims of a currency war game. That's a very meaningful problem, and I think before venturing or hoping anything from coordination, we have to agree on which game we're playing. And I refer to one paper which I thought was probably the most important paper from last year by Caballero, Faria, and Gurenchas, which I think to me explains quite clearly which game we are playing or which game we should be playing. And I think the two games we should be playing, and this paper explains, I think, quite clearly how essentially we are in a liquidity trap and basically by abusing monetary policy, we're actually spreading the deflationary shock and the liquidity trap to the rest of the world. And they argue that once at the zero lower bound, monetary policy alone cannot ensure anything else but spreading the liquidity trap globally. That speaks very strongly for playing 2 out of the 4 games that I've described earlier: the locomotive game for fiscal policy and the currency war game for monetary policy. So what does this game look like? If you look at the currency war game, I'll go very quickly over this. I've stolen these tables from Frankel. Basically there are 2 cooperative outcomes. There is what he refers to as the superior cooperative equilibrium, which is I don't know if I can do that, but which is basically the top left, which is basically one where everybody refrains from monetary expansion from where we are, from the zero lower bound. So no more negative interest rate policy, no more additional quantitative easing from where we are, and by virtue of preventing further monetary expansion, we basically stop the spreading of the global liquidity trap. An alternative to that is the currency war game, in which we seem to be, which is that everybody has an interest to run after its tail and to try and expand monetary policy more, but without creating the sort of effect that you would expect. Because if you assume that at the zero lower bound, when credit spreads are on the floor, when the term premium is at 0, the only effect of monetary policy moves via the exchange rate, you're in a situation where basically you're not having much effect. That leads to a complement to the currency war game, which is the locomotive game. And I think basically even in these 2 cooperative outcomes, we're at best in a status quo insofar as stimulating demand. The only thing we need, the next thing we need as a complement, is to play the locomotive game. And here there's an important element. So I've stolen this table again from Frankel. The only cooperative outcome that works is the bottom right outcome. Is basically an outcome where everybody expands fiscal policy. However, we seem to be very far from that outcome. In the US, fiscal policy is unchanged, roughly. In the euro area, there is some hope that it's expanding, but very mildly so, and much more so in response to the refugee crisis, rather than to a concern for global macroeconomic stability. In Japan, there are some mild efforts to expand fiscal policy, but they remain small. And as Jean-Pierre was explaining yesterday, they seem to be very much crippled by the created Ricardian equivalence that undermines the effect of fiscal policy. So I think the big discussion insofar as cooperation is concerned is how much can we cooperate on fiscal policy globally and how quickly this is likely to happen. I think this can only happen if we deal with another coordination problem, which is the domestic coordination problem. And in that sense, there is a lot of discussion that are emerging, but haven't yielded a lot of fruit, which is the discussion between a better coordination framework between fiscal and monetary policy. The bad word for this is helicopter money. The simple way of formulating it is basically money-financed fiscal expansion. This, to me, outside of whether you believe in the benefits of that or not, raises fundamental political economic questions. Because if we were to agree that at some point we need to engage in money-financed fiscal expansion, the critical issues are who decides of this money-financed fiscal expansion. And you have 2 polar opposite situations. One in which basically the fiscal authority decides that it should expand fiscal policy by, say, 2 percentage points of GDP, and that the monetary authority should finance that completely by permanent expansion of the money base equivalent to 2% of GDP. The problem, if the sequence is in that order, is that basically the fiscal authority has decided how much the monetary authority should expand. And therefore, by this process, the central bank has lost, or at least seen its independence somewhat curtailed. The alternative is for the Monetary Policy Authority to say, well, given the strength of the deflationary shocks we're facing, I'm willing to expand the money base by 2% of GDP, and therefore that limits the fiscal expansion to 2% of GDP. The problem with that is it's the opposite. So it's complete monetary dominance, and that means that it's basically central bankers, unelected officials, that would decide not only on money expansion, but also on the size of the fiscal stimulus. So I'm putting this here on the table because I think the next step in domestic and international economic policy coordination will pose fundamental questions on the interaction between fiscal and monetary policy, and so far we have evaded these debates. A last point, going back to, in fact, the earlier panel, and echoing some of the points that were made in conclusion by Lin Jianhai. We haven't discussed SDR at all, and I think I'll go back to my to my first slide. We haven't discussed SDR at all. Well, in reality, they could be an important way for the monetary system to deal with some of the shocks that we have described. One, if the IMF has more authority to expand the SDR allocation. This has been done, in fact, rather timidly during the 2008-2009 crisis, but this could be something that is revisited now. In particular, if the SDR changes from being a very secondary reserve asset to becoming a more prominent one. And on this, we will have to see how the inclusion of China in the SDR basket could potentially change its use from a very second-tier reserve asset to a more prominent one. There's one other element in the SDR which we haven't discussed, which has been forgotten, in fact, which is the use of what is called the designation mechanism of the IMF, which basically allows the IMF to force any countries participating in the SDR basket to basically sell or buy FX reserves versus the SDR basket. So basically that would be an instrument that could create a de facto FX swap line via the SDR by basically forcing any of the central bank taking part in the SDR to buy SDR from the rest of the world and sell hard reserves in its stead. I mean, I'm probably dreaming about the use of the SDR in the future, but I think, given its use in the past, but I think we should be open to the idea that the SDR could change. The nature of the SDR could change in the future, in particular if China plays a role in changing its role. I was surprised to hear in one of the G20 discussion precisely on the reform of the international monetary system, that the Chinese authorities were saying that their plan in the next 10 years was to issue large amounts of debt in SDR. So that could change over time the nature of the SDR basket. And the last point, which I've made very quickly in the comment about the FX swap lines, I really think we and the Federal Reserve should start to think of these FX swap lines not as temporary emergency liquidity stopgap instruments, but more and more as permanent features of the international monetary system designed to backstop the global funding market. Because we don't realize it so much now, but the wave of financial deglobalization that we have seen over the last few years and that is likely to deepen will actually make these FX swap lines a lot more needed than they have been so far. Thank you.